Welcome, everybody, for today's audio conference on the federal rules for travel pay. Most of the rules about travel pay come from not the IRS, but from the Fair Labor Standards Act. You know, an ancient regulation that was crafted and passed by Congress, mainly in order that laborers were not taken advantage of. And I think it's easy to see how employers can do that in travel pay, because if you just hire somebody, say, I'll give you $10 an hour, but have your car ready because you're going to be doing a lot of traveling, and no, we don't reimburse you for the expense. Well, then you can imagine how much that $10 an hour goes down. So now, of course, excuse me, like anything else, might have gone a bit overboard, but such is the nature of legislation. All right. So we'll talk about what's new for 2023. I have a little thing on business income tax overview. Employers don't want to get confused in what is deductible for income tax versus what is non-taxable to employees in terms of travel expense. And it's kind of easy to do. So we'll go over just a little bit of that for you. Then we'll go into what is really the heart and soul of it, accountable plans. So when you send employees over to travel for you, you have to keep accounting. The traveler has to account for their expenses, and you have to review and do the best you can to verify them. It has to be detailed enough. And so we'll get into what that kind of stuff means, because the upshot is this. If you do not account for travel expenses under what is deemed an accountable plan, all of the expense reimbursements you make to your employees will be taxable wages to those employees. And trust me, they will not be happy. We'll talk about the Fair Labor Standards Act, compensable time. Okay, a very important question. When you send somebody out to travel, you have to watch the hours they spend traveling for you, because some of those hours are going to be compensable for wages, which can not only affect gross pay, but overtime. And I'll tell you this, folks, if you do not pay overtime when it's earned and due, the Department of Labor is going to want to have a talk with you, and it will not be fun. Tax home. What happens if you send somebody out to travel, do something for you that takes a long time? And by long, I mean over a year. Things get radically different. I'll let you know what that is. And we'll talk about per diems, which is an excellent, easy way to expense non-taxable, taxable to the employee now, non-taxable expense reimbursements for lodging, meals, and incidentals. Notice that does not include air travel, cab travel, Uber and Lyft travel, etc. And we'll talk about specifics on meals and entertainment expense rules. In other words, which of those, if you reimburse to workers, can be considered non-taxable to that worker? And when does it cross the line? It is never wrong to reimburse workers for whatever you want to reimburse them for. You just have to watch what has to go on their paycheck as taxable wages. And we'll talk about some specifics on transportation expenses, commute expenses, and then use of an employee car for your business purposes, or use of your car for business purposes or their personal business. Because I think you can already understand there which is going to be taxable wages and which isn't. We'll talk about one of the things that us consultants find as a problem in this arena, and that when an auditor or reviewer comes, they find problems. And that is in accounts payable versus payroll department communication. Because most expense reimbursements are paid through accounts payable, not payroll. And if your accounts payable employees are not trained, they'll just let it slip. And auditors and reviewers find a lot of payments that should have had taxes withheld and didn't. And folks, the number one goal for a payroll tax auditor or reviewer is not to make sure your 941s add up. It is to find payments that should have had taxes withheld and didn't. All right. So new for 2023. The mileage reimbursement is currently 65.5 cents per mile. Now that is certainly, I think it was 58 cents last year. But we all know how much more expensive traveling is getting. Use the cars. So they set a line that if they use their car for your business, you can reimburse them up to 65.5 cents per mile without being taxable to them. Under some circumstances, you can also use it when you let them use your car for their personal use. We'll get to what that is. Qualified parking exclusion and commuter transportation benefit. For 2023, the monthly exclusion for qualified parking is $300, and the monthly exclusion for commuter highway vehicle transportation and transit passes is $300. In other words, you can reimburse an employee to use your building's parking lot, or transit, subway, train, bus, etc. Up to $300, and it's not taxable to that worker. Past that, it is. And an auditor or reviewer would expect to see whatever is past 300 as taxable wages to that worker. All right, about business income tax. As a general rule, entertainment expenses are no longer deductible on income tax return. Entertainment, okay? I believe they found it is getting way too abused. And entertainment that had nothing to do with your business was being deducted for business income tax. You also have to watch out for the same thing if you're reimbursing employees for entertainment they do when they're on travel. You have to have a good business reason for that entertainment, and you have to note it, or it's going to be considered taxable wages, both to either your business, well, that would be taxable income for your business, taxable wages to the traveler. There's plenty of differences in accounting methods and tax law, income tax law, neither of which I'm an expert in. Accounting puts me to sleep. But you have to watch out for things like this. You can deduct 100% of the cost of meals on your business books and records. However, only 50% of the costs are allowed by law as a income tax deduction for your business. So long as the expenses are recorded under an accountable plan, they can be listed on income tax returns as travel and non-entertainment meal expenses. Accountable plan, which we're just about to get to. If recorded under a non-accountable plan, all expense reimbursements go on their paychecks and W-2s. And then for your accounting records, tax records, they count as employee wages. Publication 535 has much more about several topics like employee activities, highly compensated employees, there's a difference there, etc. It's a good publication to review. Can't go over it all here. All right, accountable versus non-accountable plans. So again, I explained it's black and white. You keep records that can be deemed an accountable plan for this stuff, essentially meaning your workers give you records and they don't have to be complicated about what they spent it for. The business reason is key. They will tell you that there are some expenses that are obvious. Okay, you're flying me to Miami. Well, I have to get to the airport to my hotel. But it still never hurts. On my expense report, I just jot that down. Uber ride from airport to hotel, X amount of dollars. Because that, even the most numbskull of an auditor or reviewer can tell you, yeah, that's going to be business. These are the elements of an accountable plan. Plan must have a business connection by providing advances, allowances, or reimbursements that are incurred by an employee in connection with the performance of services for the employer. It says for deductible business expenses. If you can't deduct it as a business expense, then it's likely going to be taxable wages to the worker you give it to, because it has no business purpose. Plan must require the employee to substantiate reimbursed expenses within a reasonable time. We'll get to that. And the plan must require employees to return advances in excess of substantiated expenses within a reasonable period of time. We'll get to that. Business connection evidence. This does not have to be an encyclopedia. Just enough document or description about what the expense was for, and a signature from the employee that that's what it was spent for is usually enough. Substantiation of reimbursed expenses. Again, sufficient information. Can be receipts, and receipts, of course, can be electronic, most are. Just make sure there's enough for an auditor or reviewer to understand it had to do with your business. Each element, by that we mean category. Any travel, any meals, any entertainment. They all, you know, those what I mean by element. What they don't want to see is travel expense report, employee X, dates January 1 through 7, destination Miami, Florida, total expenses $5,000. That is not detailed enough. And if that's all they see, especially without receipts and everything else, and without the totals by element, it's going to be deemed non-accountable. And that $5,000 will all of a sudden be taxable wages to employee X. Again, receipts still work. And there is a minimum for most expenses where you don't even need that. A simple line item saying, yeah, that Uber ride from the Miami airport to the hotel was $40. All he has to do is says he took it and sign it. But items over $75. Oh, and that, by the way, does not include lodging. Lodging, any amount spent on lodging needs to be validated. Again, it was just too easy to take advantage of. People go stay with friends, say they stayed in an expensive hotel, got a lot of money from you. A common practice in travel pay is use of advances, right? Heck, if I'm going to Miami for you, I don't have $5,000 to cover the expenses till I get back, and your AP finally reimburses me. So a lot of businesses just say, okay, fill out anticipated expenses. Where are you going to stay? How much a night is that? How are you going to get there? How much is that? Meals, especially if you don't use per diems. How much are they? Or how much do you reasonably anticipate spending on meals? You kind of look-see over it and say, seems reasonable. In other words, it seems that it'll be pretty close to what it actually spends. You may owe him a little bit more. You may take a little bit back when he gets back. That's what you're looking for there. What's reasonable time? This slide, bullet 1. An advance must be made within 30 days of the expense. And by the way, call it 30 days of the trip. "30 days, folks." You know how much more expensive air travel can get if you wait for 30 days or less, and sometimes you won't get it at all? So, what's a business to do? Well, there's a couple things. What I recommend for things like flights or lodging that I also have to book well in advance or risk not having a place to stay. Just pay for it, business. Just pay for it up front. Pick a flight, book it. Pick a hotel, book it. Pay for it, and cut out the middleman. That can still be reviewed. So just keep more notes about what it's for and why they had to go there. But it's by far the easiest. The other way is if you have the employee pay for that kind of thing more than 30 days prior to the trip, don't reimburse them until 30 days. When they get back, they got 60 days to do that travel expense report. Most businesses want it far quicker than that. Now, if they end up coming back and owing you money for it in advance, get it back within 120 days or it's going to be considered a loan to that worker. What about traveling salesmen? I mean, that's all they do is travel. You do not have to account for it trip by trip. You can have what's more or less a revolving fund where they draw stuff as needed, account for it in a reasonable period of time, and balance the books. That's acceptable for people who do a lot of travel. 120 days. So every 4 months, make sure that happens. All right. So in terms of monies, and let me give you an example. You send employee X to Orlando, Florida. Employee X's kids looking him up and say, Daddy, Daddy, can we go? Daddy says, sure. And you say, you know what, Employee X, you're very valuable to us. Go ahead, spend some time with the family at Disney World or whichever. We'll pay. Okay. It's fine. None of all that. But that has to be taxable wages to that worker. Okay. And so when you face expense reimbursements that are taxable to that worker, you can withhold at 22%. That's through 2026. Or you can put it through payroll and let their W-4 figure it out. Wage recharacterization is a common practice that automatically puts your accounting and your plan into non-accountable, because it's kind of like a trick to make non-taxable wages seem taxable. I'm sorry, to make taxable wages seem non-taxable. And here's one of the ways you want to avoid. All right. Whenever we send, I was in Sacramento for a long time. Whenever we send somebody from Sacramento to San Francisco, we're going to give them $500. We're not going to worry about how much he spends. Now, they might be pretty good, as that's pretty much how much they spend, especially when you consider how much it costs to be in San Francisco. But the point is, it's not accountable. If you do it that way, they have to come back and tell you how much they actually spent. If you don't do that, it's a non-accountable plan. Here's an example. A government entity employs workers who occasionally incur travel expenses for travel. Employee receives the same total hourly compensation. When the employee incurs travel expenses, the employer treats a portion of the hourly compensation as a non-taxable per diem. So they just reduce the taxable wages. Which still might be fine, but they got to account for it. Because if they don't, it's a non-accountable plan, and it will all be deemed taxable wages. That URL, if it still works, more good stuff on accountable plans for businesses. All right. Most of us understand commute expenses as if they get reimbursed are taxable wages, because everybody else has to pay for their own commute. However, if you direct them to go from one place to another from their home, that is not only reimbursable for travel, it is also compensable time. And when you start adding compensable time to an employee's day, you have to start worrying about overtime. So keep that in mind. Day trips. Day trips. Travel time on work-related trips is counted, except for meal times, right? Everybody gets a lunch you don't have to pay for. But let's take a look at an example for a day-long trip. Employee traveling by plane takes a cab to the airport and a cab from the airport to the seminar. There's an hour lunch break during a seminar. The trip to the airport is considered commute. The trip to the airport is considered commute. It is the same as them going to the office so long as that airport is in the metropolitan area. But the wage time clock starts when an employee arrives at the airport. Obviously, no payment for the lunchtime. Takes a cab back to the airport and flight home are paid time. Again, the cab back to that airport and the flight home are paid time. So if they spent 8 hours for the seminar, this is overtime. Cab home from the airport is considered commute, like the trip to the airport. Here's an interesting one. Travel time is not considered working hours unless it cuts across the employee's regular work hours, regardless of the day of the week. Regardless of the day of the week. In other words, if they are traveling on business for you, and part of that business travel demands travel on the weekend, this would not mean I have the option of traveling Friday afternoon, but I choose not to. That's a choice. However, if they have to, because there isn't any other choice, any hours they're traveling during their regular business hours, regular work hours, will be deemed hourly wages. Interestingly enough, they travel past And again, on the weekend, they travel in hours, not the regular hours. It's not wages, but it would be on weekdays, assuming they have a regular weekday schedule. All right. Tax home of the 1 year rule. Does anybody really want a tax home? I don't. But we all have one that's usually called our home, apartment, whatever state it's in. But now, and let me give you this example. I had a brother-in-law that opened up Home Depots across the nation. Average time, 9 months. Sometimes, when you got to a really nasty regulatory state, it can take over a year. Most of the rules of this apply to anything under a year. You get over a year, all of a sudden, their tax home is not the state they live in anymore. It's going to be that state they're in and working in. And that means a heck of a lot for that employee, like they have to register there, file a tax return there at the end of the year, etc. And here's the rub. Every payment from day one made to that worker who works over a year for their living is taxable wages to that worker. Once again, if they work over a year, every payment made for their living expenses is taxable wages. You're paying for them to live. Everybody else has to pay for their own way to live, but it's only for after a year. Now, okay, Mark, we sent them there. I thought it was going to be 9 months. One thing led to another. Okay. Well, as soon as you reasonably deem that that trip's going to take over a year, then you start making all living payments as taxable wages. You don't have to go back. All right, so for temporary assignments, general rule is that reimbursements for daily transportation expenses incurred in traveling between a residence and a work location are treated as taxable wages. It's not applicable to traveling between two business locations. Okay, tell them to go from your headquarters to another office, not taxable wages. But again, if you reimburse for normal commute stuff from their residence to wherever you send them, so long as it's in the metropolitan area now. Different when you get outside the metropolitan area. But again, paying for commute, if you do that, taxable wages. What is away from home? Supreme Court says long enough to require substantial sleep or rest. Thus, merely working overtime or at a great distance from the taxpayer's residence does not create an exclusion for reimbursements for travel expenses if the employee returns home without spending the night. Example, employee is required to travel from Milwaukee to Madison, that's in the same state, by the way, to work on a project. She leaves home at 11 a.m., plans to return home same day. She can't do it, so she spends the night in Madison. Completes the project, returns to Milwaukee by 10:30. Even though she hadn't planned it, the fact that she did it means she was away from home. Employee is required to travel from Dallas to Austin. Employee leaves home at 6:30, returns that night at 10. On a trip home, the employee stops for dinner, rests in the car for 2 hours. Even though the employee has been away from home for substantially longer than a normal workday, she is not considered to be in travel status. Courts have ruled that stopping for a meal or a rest in a car does not meet the substantial sleep or rest rule. Government agency supplies office equipment to other agencies within the state. An employee drives a tractor trailer with equipment in Sacramento to an agency in San Diego. That's a long trip, folks. After 10 hours, the driver stops and rents a room for a 4-hour nap. Because the purpose was to sleep, he met the sleep and rest rule. All right, I already told you what the past the year thing means. All right, per diems. Per diem is a flat rate, 2 types. IRS has one, which in my opinion, not as good as the GSA one. The GSA one has, and remember, per diems are for lodging, meals, incidentals, like, shaving cream, deodorant, that kind of thing. If you advance the per diem rate for that or reimburse at the per diem rate, you're fine. In other words, not taxable wages. And the GSA has amounts per metropolitan area in the whole country. It'll let you know exactly how much you can reimburse. Now, does that mean they can't spend more than they're come back and say, I need this extra? Sure, they can. If they can substantiate it, reimburse it, and it's still not taxable wages. But they do not have to come back and account for anything so long as it's the per diem rate. So it's a heck of a lot easier to agree with your employees for lodging, meals, and incidentals to pay per diems. More on those in the interest of time. We'll skip them. You can read it if you want. Lodging is a little different. Again, anytime you pay for lodging, you have to get a record of that lodging. Again, it was taken too much advantage of, but not the meals and not the incidental. You can pay for meals and incidentals if you provide the lodging and can show that. Again, pay it directly to the hotel. You have to account for it. Meals and entertainment. Employee must substantiate by adequate records or sufficient evidence corroborating the taxpayer's own statement the following elements: the amount, date, time, address, place, time and entertainment of meal, business purposes, and benefit to be gained. This is especially true for late night meals and entertainment. If they're entertaining a client, there has to be some evidence that business was discussed or negotiated. They're going to look hard at entertainment. Take somebody to that World Series that just ended. You don't talk any business. More than likely, reimbursement to you that you paid for, you and the client, reimbursement from your business is likely going to be taxable wages to you. But rather easy to conduct some business, don't you think? All right, so what is appropriate entertainment expense? Ordinary and necessary, whatever that means. But there are definitions of this if you just look. And if they're either directly related to your business or associated. Right? Ordinary, necessary. One that is commonly accepted in your trade or business. A necessary expense is one that is helpful and appropriate for your business. An expense does not be required to be considered necessary. The directly related test. To meet the directly related test for entertainment meals, you must show that the main purpose of the combined business and entertainment was the active conduct of business. You did engage in business with the person during entertainment period. And you have more than a general expectation of getting income or some other specific business benefit. Think hard. Write a little narrative about it. Most of the time, you're going to be fine. The associated test. You must show the entertainment is associated with the active conduct of the trade or business and directly before or after a substantial business discussion. So you see, you don't necessarily have to discuss other business, just say it's associated. Lavish, extravagant expenses. Let's just be blunt. $5,000 spent at a strip club is going to be questioned in terms of business necessity. $5,000 steak dinners with champagne. Unless you're dealing with Arnold Schwarzenegger or somebody of that nature, you're gonna have a tough time convincing an auditor or reviewer that was necessary. Nothing wrong with reimbursing them. It's just what's taxable wages. That's all we're talking about. All right, we already said that $300 for parking and or transit. You can give every employee that so long as they use it. And it's not taxable anymore. It is. Some numerical examples there you can read if you like. All right. Use of an employee's personal car for business. A mileage allowance paid at a standard mileage rate, a flat rate or stated schedule, or any other IRS specified rate that is less than or equal to the federal standard mileage rate, 65 cents, multiplied by the number of business miles is deemed substantiated and non-taxable. You can also try to figure out if they use their car regular basis. You can try to figure out for fixed and variable costs. You got enough information to support it? You can use that. It's called FADR. For when they use your car, they have to let you know how many miles they spent traveling for you versus themselves, if that's applicable, and the business purpose. Now, if they do intersperse business and personal use, the fair market value of that personal use goes on their paycheck as taxable wage. They don't report it. It's all taxable wage. De minimis. No, you don't have to worry about sending Bob down to get donuts for the 9 o'clock staff meeting. It is deemed impractical to account for that, so you don't need to worry about it. There are other things as well. Just don't get crazy with de minimis, because the definition of de minimis is impractical to account for. It does not have to do with minimum amounts. A $25 gift card given at Christmas to your workers are taxable wages to those workers. Why? 25 is 25. It's easy to calculate. You put it on their paychecks as wages. I don't know how many employers do that, but it is the rule. It's one of those things I look at and say, okay, I have 100 employees, 25 each, 2,500, 40%, 250 times 4, 900. Auditor, come to your worst. Give me back taxes on $900 per employee, because most businesses can handle that. In these kinds of things, 100% 100% compliance is all but impossible. So don't try. Only worry about the stuff that your business does regularly and make sure you're doing right. If they use your car, they use it for personal use, you don't have to withhold fit. You don't want to. Sampling can be used for employees whose personal/business miles are relatively the same and don't fluctuate. Sampling allows the employee to monitor mileage for a represented period of time, such as 90 days, and provide a statement to the employer that business use does not change significantly and that the employee will notify the employer if it does. And then you can say, okay, we agree that this month, 400 for use of that car will be taxable wages, the rest won't. There's also a general valuation method. If you give the car to one employee, you have to figure out its fair market lease value if possible. And then you say, okay, personal use 40%, business use 60, lease value 500 a month, 400%, 200 goes down as taxable wages. That's the lease value. You use cents per mile. If they're driven over 10,000 miles and with a fair market value not exceeding 16,000. Commute. Normally valued at $150 one way, $3 per day at normally taxable wages. All right, finally, accounts payable versus payroll department. You got to train each other, folks. If this is all AP stuff, they're going to make mistakes. And then you're fodder for the auditor. So train each other. For a while, have AP tell you exactly what travel expenses were paid to who and for what. Some other questions to ask yourself. Best practices. Do not deduct expense reimbursements from gross pay. That makes gross pay less than minimum wage. That is a big no-no. Paying less than minimum wage, big no-no. Always document. Doesn't have to be an encyclopedia. You start deducting large amounts for car uses. Keep track of who benefits. If there's a business use, note it. If you can't, taxable wages. Inconsistent treatment among like workers. You have really good salesmen that you give a lot more perks to, but the other salesmen have the same job description They have to be treated the same, or your plan will be deemed not accountable. If a reviewer looks and says, yeah, these are obvious estimates, right? Gas expense, $300. They're going to ask for the records. If you start estimating non-accountable, all right. I have plenty of supplemental material on all this stuff. MarketMSPayroll1.com. Let's go ahead and open it up for Q&A.